Good afternoon, Happy New Year, and welcome to the first webinar of 2026. I'll be looking at how prices have moved in motor and home insurance in Q4 of last year and going back a bit further and to look at the trend and think about what we might expect coming up in this year. So before I do that, I'll give a quick intro into who we are. So Pearson is a pricing consultancy. We work across multiple industries, insurance being one of those. And our mission is to help our clients succeed through better pricing. And we do that in several ways, through pricing consultancy, price optimization, capability development, as well as market price tracking and insights in insurance. The approach that we take, so this is a bit about the methodology. We use real consumer panels. So these are actual people. They've given us permission to use their risk details, and we run those through the Big Four price comparison sites who we have agreements in place to do that with. So we like to replicate customer behavior as much as possible. So there's a panel rotation of people. So it's not running everybody every day, but there is always a proportion of people who will be the same as the previous day. And we look at that on a day-to-day basis as well as month-to-month. And that's the data that we'll be using in the presentation today. So there are a lot of unusual pricing rules that you have to be wary of in general insurance pricing within the UK, and that means we have to design the approach in such a way as to mitigate the impact of some of those rules, as well as working with our broad client base to exclude our quotes from some of those rules. And data cleansing is also carried out afterwards to remove any outliers or anomalies to make sure that what we report is the most accurate view on price changes within the market, rather than price movements that might be triggered by things like the number of quotes that have been requested by a certain individual. And because it's a basket of real consumers, it's the same profile. So we use comparable policies. So it's the same people to track price changes rather than price movements, which if we were looking at average prices from PCWs, could be influenced by mix changes over time and seasonality, and the use of a panel of the same profiles mitigates that as well. So that's what we'll be looking at today. As we go through, please log any questions that you might have in the chat, and I will endeavour to answer those at the end if we have time. So just again, we cover car insurance and home insurance in this webinar, but we also provide similar services for pet, travel, van, and landlord insurance. So if you'd like any more information on that, then please feel free to contact me, and I will be able to help you out. Okay, so moving on to motor insurance. So how did motor insurance move at the end of the year in the last 3 months? So we've seen prices continue to drop. So prices have come down in Q4 by another 1.4%. So this is a continued series of price reductions each month. However, the rate of reduction has slowed down. So if we think about what was happening prior to this, we saw drops of 4% in Q2 and 3% in Q3. So it is certainly slowing down in terms of the rate of price reduction that we're seeing. We can see this by looking back over the 6 months, where July, August, and September, average price change of about 1%. And we can see that that has changed, and we can see the line there plateauing. And if we look back over the course of the past 12 months, so year-on-year prices are now around 11.5% lower than they were this time last year. So we can see that line and where the prices have fallen and how that is starting to slow down, and we're seeing a bit of a plateauing as that may be bottoming out. Looking back over 2 years, so from the beginning of 2024, when the bulk of price reduction started, so we can see that prices now are around 25.6% lower than they were 2 years ago. So it's been a prolonged period of premium deflation, and obviously it's a good time for consumers compared to what they were experiencing beforehand, but it's probably reached a point where it's becoming less sustainable on average for insurers. So we'll talk a bit more about that later on. So this is a favorite slide of mine, looking back to the beginning of 2020, before all of the craziness happened. So there are kind of 4 distinct periods that we can see here. So there's COVID, so the impact of COVID bringing prices down, largely due to the reduction in claims. So with customers in lockdown and not driving to the extent that they had expected to, claims frequency is obviously greatly reduced, and that we see being passed on to customers in terms of price reductions. At the beginning of 2020, actually, this was at the end of a downward cycle, so I was expecting prices to start to rise then, and they did in January, February. March is when COVID hit, so that's when we see the prices starting to drop. So they may have come down more than they should have done at that time, and that might be what's driving the subsequent period. So we then have regulatory change, so general insurance pricing practices, alignment of new business and renewal pricing, which resulted in a significant increase in quoted prices, so new business prices having to come up to meet renewal pricing, which came down, and this led to a kind of an increase in retention, but a kind of reduction in shopping around and an increase in quoted prices. We then have this period of soaring inflation, so inflation within kind of more general market, but hitting the kind of the motor and home insurance markets significantly and forcing premiums up to kind of points where insurers there then felt comfortable in terms of profitability. And over the past couple of years, there's this increasing competition, and I would say kind of a normalization. So it's kind of the past 5 years has been quite unusual in terms of the insurance market and pricing, driven by some of these external factors. And I think we're starting to get into a place where things are normalizing a bit. So looking at a basket of large insurance providers, so this is more or less a top 10 of providers on the PCW channel. How have prices moved? So we've seen the average, which was about a 1.4% reduction on the previous quarter. However, sitting below this, there's a lot of upward and downward movement. So we can see price increases here of up to 8.4% on the previous quarter for one of those providers. And certainly kind of there's a section in the middle where prices remain relatively flat. So it's increases as well as reductions coming in. So there are still some insurers who feel that they are able to be competitive and have continued to drop prices into Q4. This is a trended view of the first 5 of those providers. So this is where we've seen prices drop or remaining flat. So year on year, we are seeing one where there's a 3% increase year on year, but the variances there outside of that are they're more around 10, 12, 13% down on last year, where we've seen prices continue to fall. Where prices increased, again, we're seeing a range between minus 14% down and plus 11% up year on year. So there are a few providers here that we are seeing positive variances year on year, even though the overall average, and this is based on the average of the top 5 quotes. So this is the competitive price within the market, and how has that moved, is down 11%. We are seeing individual providers where prices are higher than they were last year. So there's a lot of divergence in the market. So depending on who your competitors are, you'll be feeling the pinch or not, depending on where you sit. So I think we can split it out into 2 distinct groups here. So there are those where prices have increased year on year and those where prices have reduced year on year. So for the first group, we've seen prices kind of leveling out in Q1 before starting to creep up in Q2. And for the second, prices have continued to fall in Q1 before then leveling out into Q2. So I think that they're probably moving in a similar direction, but they may be slightly behind. So I think it may be a combination of where prices have increased, insurers have felt the pressure and not been able to sustain levels of competitiveness, or it could be that those where prices have continued to reduce are feeling much more comfortable and are able to continue to compete and drive forward those growth strategies. Looking at some segmented views, so this is by driver age. We can see there are some variances. The range is between -9 or -13%. So there is a bit of a range there. Price drops for older drivers are not as big as those for younger drivers. So younger drivers have seen bigger reductions. Looking at the number of years NCD, so in terms of profiling of risk, we can see that there are some differences. That orange line is 9+, where prices have stopped reducing. So that's kind of plateaued out at the end of the year, whereas we have seen prices for 0 NCD continuing to fall sharply into Q4. So it's an interesting view on different approaches to risk based on a number of years without claims. Annual mileage, again, there's a range here between 10% and 13% difference. So those, again, the prices for drivers with the lowest annual mileage have dropped by 9.7, and it's more like 12 to 13 for those with more normal sort of 6,000 to 12,000 kind of miles. In terms of different product approaches and strategies, so this is looking at a couple of the large providers where they have different tiered products as well as telematics, and how prices moved for them over the course of the past 12 months. So we can see that in terms of the standard tiered products, so this is your economy, standard or premium products, that prices have moved in a similar direction over the course of the year. There may have been a slightly increasing gap between the economy and the premium, but more or less following the same trend. We are seeing, and particularly on provider 4 here on the right, a big reduction in price for its telematics offering, and this is likely caused provider 2 to start to reduce prices in that area as well towards the end of the year. So it looks like there's more of a focus has been placed on telematics products towards the end of the year, with prices reducing there. But interesting to see where prices have been able to increase. So for provider 4, for example, they have chosen to offset that with reductions to its telematics offering. So that's where we are with motor insurance. Moving on to home. So this is combined buildings and contents cover. So again, we've seen prices continue to drop by just under 1% in Q4 of last year. So this is for combined buildings and contents cover, and it's on the same basis. So it's the average of the top 5 quoted prices. So this is what does a competitive rate for home insurance look like. So yeah, we've dropped by just under 1% in the quarter. And we can see, as with motor insurance, this is a continued reduction, but it is a slowing down of the rate of reduction. So we can see that in the previous quarter, there were far larger reductions being applied. And if we go back further, so looking back over the course of 2025, prices now are around 12.3% lower than they were this time last year. So in a similar area to car. So we have seen consistent price reductions each month throughout the year. And as I say, is as with motor, it slowed down a bit towards the end of the year. Looking back over 2 years, and again, the variance between 2 years ago is a negative one. This is for the first quarter that we've seen this, that prices on home insurance are now lower than they were 2 years ago. So as I say, the rate of decline has reduced, but there was a significant period of premium inflation which happened before this. So they were in a high spot to begin with. Again, that is the average that we're looking at. So how is that competitive price moving within the market? Sitting below that, we are seeing different approaches and different strategies playing out by different insurance providers. So again, this is a basket of 10 large providers of combined cover, and we can see that there is a split. Half of them have increased prices and half of them have reduced prices during that quarter by similar amounts. So there's a lot happening below the surface. So if you're just looking at that average, then it's not telling you the whole story. So this is a similar view to motor, where prices have continued to fall in the last quarter of the year. We're seeing price variances year on year between 3.4% and 12.5% for those individual providers. So we can see that the price reductions have continued to be fairly consistent over that period. There's one there, provider 5, where it kind of plateaued in the middle of the year and has stayed fairly flat since then. But the others have tended to continue consistently to reduce. Where we are seeing price increases for combined cover in Q4, there's a slightly different picture. This is where price reductions were a bit steeper at the beginning of the year and then plateaued out around the middle of the year and then have started to creep up again. We see the range actually is very similar. So between 3.4% down and 11.5% down year on year because of the sharper reductions that we saw in the first half of the year. So they've ended up in a similar place with different approaches. So again, if you are competing in this market, then you need to be able to see which approach and which strategy your competitors are pursuing and how that is impacting on your own performance. Contents only. So again, what's happened in Q4? So a similar reduction. So 1.3%. So in between the combined cover and motor insurance. So it's a very similar trend that we're seeing. So prices have continued to drop, but the rate of reduction has eased off a bit. So looking over 6 months, we can see actually in October, we saw prices in contents only increase between September and October, and then started to come down again in November and December. So that's kind of reduced the overall average for the quarter, but also November and December reductions were lower than we had previously seen in the 3 months prior to that. And again, if we look back over the course of the year, prices are about 12.5% lower than they were last year. So again, it's similar to what we're seeing in the other sectors. So kind of fairly large reductions year on year. And over the past 2 years, prices are now about 10% lower. So we have seen bigger reductions in contents only than we saw in combined cover, which has resulted in this larger variance over that 2-year period. Again, a similar picture. So although that average is at minus 1.3%, that is driven by a range of different price movements by different providers during that period, with increases of up to 9.3% being observed by one provider of contents only here. So again, there are different strategies. There are divergences in price movements in both directionally and by magnitude of change. So we're seeing a lot of different activity and different things happening within the market in motor and in home insurance at the moment. So again, this is a trended view for those providers over time, and we can see there are ranges here between plus 9% or minus 24%. So some big variances here that we're seeing year on year. This is where prices reduced in Q4. Where prices have increased or remained flat, they are still below. So minus 1.8, minus 11.6% year on year. And again, that's kind of much flatter, so plateauing earlier and then creeping up again. So again, similar to what we've seen on combined cover, and I would expect where insurers are starting to creep prices up, that would continue as we move into next year. Okay, so that's what we've observed over the course of last year and looking at the last 3 months of 2025. So we have seen significant price reductions in all of the sectors for 2 years, and it looks to be slowing down a bit. The average movements, if we were looking at this a few months ago or a few quarters ago, then we would see that those baskets of top 10 providers all moving in a similar direction by a similar amount. It's over the past couple of quarters, over the past 6 months, where we started to see that divergence, and that has accelerated in the last quarter of the year. So we're seeing much more divergence within the market, and whether it's driven by necessity or whether it's driven by and the need for growth by those providers who are still able to do that, uncertain, but we are seeing those certainly differences in strategy and approach playing out. So what do we expect to see this year? So it's a difficult one to call, which as always, there are pressures for prices to continue to rise, and there are pressures on prices to continue to fall. So in terms of what drivers there are for price reduction, so we are seeing a lot of consolidation in the market. So we've got obviously Ageas and Esure, we've got Aviva and Direct Line, we've got Market Study and the Atlanta Group, and I don't think we've seen the kind of the full benefit, or they've been able to realize the full benefits of those mergers and acquisitions yet in terms of cost reductions. And once they are able to do that, there may still be some fuel in the tank left to maintain more competitive rates. Underwriting performance has been pretty good, so strong financials being reported in 2024 and in 2025. EY are predicting an industry COR of 101% for 2025. So again, that's an average. So there will be some insurers who are performing better than that, some worse than that. So actually, there may still be room for some price reductions if those growth strategies are to be achieved. So again, the initial premium inflation that we saw in 2022 and 2023 supported some price reductions, and actually we're probably in a decent place now. So I think there are some insurers who will be doing better than others and are still able to maintain competitive rates for a little bit longer. Technical enhancements could help, so both in terms of improvements to vehicle safety, which could reduce the frequency of claims. I think that's helped to keep the frequency down last year and could continue into this year. Acceleration of AI, again, everybody's talking about it and everyone's trying to do it as quickly as they can. And there's a potential for cost reductions if that can be rolled out, particularly in kind of claims handling and those sorts of things, potentially in pricing as well. So there are opportunities and potential to drive things down. The competition is still there. It's a very competitive market. Insurers have ambitious growth plans, and if they want to achieve those, then they need to be competitive within that market. On the other end, what drivers are there for premium inflation and prices coming up? So those underlying issues that we had previously are still there. So general rates of inflation are remaining stubborn. Household finances are tight and showing little sign of easing, and labour shortages, supply chain issues are having an impact on the cost of claims. Extreme weather events making claims somewhat more unpredictable. So all of those things are still there. So there are still challenges in terms of the cost and frequency of claims. The last time I spoke about the pricing cycle, so the insurance pricing cycle, where competition drives prices down until they become unsustainable and insurers are making losses, and then come up again until people are more comfortable, and then come down again. Tipping point usually around where CORs are at 105, 106% at market average. EY is predicting a 2026 figure of 111%. So this is based on a 3% increase in premium in the year. So if prices rise more than this, underwriting losses may be limited. But I think we're certainly at a point where people will be worried, and rightly so, and more cautious in their pricing approaches. So in conclusion, competitive prices have fallen over 25% for motor insurance in the past 2 years. This does follow a couple of years of significant premium inflation. So the prices are still 7.5% higher than they were at the beginning of 2020. So there may be some flexibility. There's been so much underlying volatility in the market due to those external factors that I spoke about earlier, and it does feel like we're entering more of a kind of a normalized state. So prices are probably around where they need to be. So unless anything else external majorly impacts, we should be okay. So I think there are risks. Obviously, there's a lot of geopolitical issues which are happening at the moment, which could have an impact. But I think we are entering more of a normalized state. So on balance, I would expect prices to rise in 2026, not to the same extremes that we've seen over the past few years, but probably more conservative single-digit growth. So if I had to kind of hang my hat on it, I'd say motor insurance will probably start to come up in kind of either this month or next month, and by the end of the year could have risen by maybe 6% up to kind of 9%, somewhere in that region. Home insurance, I think, will probably come up as well, but unlikely to be to the same extent. So I would expect that to be something like 3 to 6%, something like that. So that's what we'll wait and see. We'll have a look next time in 3 months at the next webinar to see where we've got to. I think we've run out of time for questions, but please do email or log in. I'll try and answer any that have been logged so far. So thank you for your time. Hopefully that was helpful, and I look forward to the next webinar in 3 months. Have a good afternoon.